What is your comment or response to the CBR remaining at 18.0%?
Thank you, Larry. I think it is a bit of a shock to the market. A lot of people are expecting maybe just a twink downward for the CBR rate, in line with what the banks have been doing. We've seen most of the banks twinking their base lending rates downward, and our feeling was that central bank would take the same line of thought. However, by maintaining it, I think the worry is a balance between inflation, a currency that is depreciating over the last couple of weeks, and therefore it was a hard balance for them, and they had to come to such a conclusion of maintaining 18%.
The MPC statement says here that despite enhanced open market operations, excess liquidity conditions have persisted in the market, and those pose a risk to demand-driven inflation pressure and as well exchange rate stability. Do you agree?
To some extent, yes, I agree. There is, we have seen that in the first quarter, there was a report showing that banks still extended over 50 billion worth of loans to the market. That augurs well with the demand side of inflation, where we are saying that people or institutions are still able to borrow at the high rate of interest rates, and that means even as central bank is struggling to bring down inflation to the target of 9%, the people have still the ability to borrow, and therefore perhaps it is good for them to rein on the demand side of things, because in terms of supply side, we have seen inflation coming down, guided by particularly food prices coming off, and that has been good. However, the demand side has remained strong, and it is maybe time that government remain tight on things so that we do not see another spike of inflation like we did last year.
The inflation target the CBK has is 9%. Do you think keeping the rate at 18.0% achieves that?
9%. Remember, they've come from 5% and they have shifted their goalposts to 9%. They have always targeted inflation at 5%. Having moved from 5 to 9%, I think it is achievable. One, because they are going to enjoy a high base, and therefore, if prices just come off a little bit, it's magnified to some extent by the fact that the base rate is high. So it is achievable, and by the end of the year, if no shocks hit the economy, we will see them actually achieve that or even surpass it and go towards the 6–7% levels.
What does this mean for interest rates, the fact that the CBK the MPC retains it at 18.0% to the CBR?
Well, hard balance. The last couple of weeks, we have seen rates trend downward quite fast, moving from highs of even 16% to currently 91-day T-bill trading at about 9%. With the new information in the market, it is not new because we have remained at the same level. I think because of demand and supply, we will continue to see interest rates trend downward. That's interest rates on treasury bills. However, on the deposit sides, we do not expect the deposit rates to come off. So we will continue to see institutional deposit rates remaining high, whereas the T-bill remains levels below 10%. So the trajectory is still downward.
How real are the threats of external shocks? The MPC says the shilling still remains exposed to the current account deficit, especially to very high external shocks.
I think that's a reality when you look at the balance of payment, where we are saying that we are a net importer as a country, and the reality of the matter is that a lot of our goods are sourced from abroad, and therefore the demand for the shilling is not as strong as the demand for the dollar. So there is a threat. If we continue demanding more foreign goods, then the shilling will remain subdued for some time, and so it is a reality that the governor faces based on the demand consumption patterns for the population in Kenya.
Elizabeth, interpret this for me, if you will. I know you haven't seen the statement, but it says the MPC will continue to will introduce rather longer tenor term auction deposits as an additional instrument for liquidity management. What does this mean exactly?
Larry, that's quite tricky for me. I'm also going to look into that later and try to understand what exactly they are going to do. But on top of my head, what I think is they are going to introduce special tools, like almost like treasury bills, and perhaps maybe introduce one which is in between the 182 day and 364 day, because you realize we have only a 6-month T-bill, and then after that we've got the 1 year. So perhaps they're going to introduce a 9-month T-bill in between there and work around it, because that has been a portion of the curve that has not been served by the government, by the central bank, sorry.